Hi, I'm Dan Goldstein with Clean Skies News. Crude oil prices have climbed to an 18-month high just over the $87 a barrel mark. Now, many economists are pegging the rise in oil prices as a sign the U.S. economy is beginning to break out of its slump as job growth showed the biggest jump in 3 years. Joining us now to talk about that is Fadel Gheit, senior analyst at Oppenheimer. Fadel, thank you very much for joining us.
Thank you.
Fadel, you've been very critical in the past that several of these oil rallies that we've seen in oil and natural gas have been basically as a result of speculative investment. Is this another speculative bubble, or are we starting to see some fundamentals at work here?
Absolutely, but you have to remember, speculation always follows signs of fundamentals. For example, the job report last Friday gave speculators some hope that that is another window, if you will, that they can push higher oil and gas prices. We also knew that the U.S. data on natural gas supply and production was basically flawed, and now we are seeing the reaction in the market. Natural gas prices are up the highest in the last 6 or 7 months on a percentage basis as a result of the potential changes in the way the U.S. government reports natural gas supply and demand fundamentals, which gives speculators some room to maneuver prices higher. But I do believe that fundamentals is turning positive, but speculation is really carrying the burden to push both oil and gas prices high.
Well, that leads me to my next question. Do you see oil prices heading back to triple digits this summer?
Well, if we continue to allow speculation to take over the physical market, which has been the case, with no interruption in the last few years, with a brief period of playing low, if you will, when we bailed all these financial institutions, they are back on the saddle. They are likely to push oil prices higher unless or until regulators put their foot down, curtail their activity, and prevent them from manipulating the market as they did 2 or 3 years ago.
Now, with that, is there a danger that the higher oil prices could choke off the U.S. economic recovery that we've been looking at, or even set off another round of inflation?
Well, absolutely. At the end of the day, something has to give. We just cannot allow or assume that oil prices will go unstopped all the way to $100 or $150, and we assume that inflation rate will remain low or non-existent. Something has to give. Either we are going to see oil prices come to a screeching halt and come down very sharply, because in my view, they are not supported by market fundamentals. I really believe that oil prices above $60 is just unjustifiable. The $25 premium that we have in oil prices is basically pure speculation.
Is it enough really to set off a round of inflation?
Well, eventually it will, but the Fed has signaled that our priority is not really to worry about inflation or contain it, because the Fed is going to keep interest rates very low, so that will help mitigate the impact of, super inflation, if you will. But eventually we will see inflation. We're beginning to see signs of inflation around commodities and other areas, and that will carry throughout the economic system. But it's not the priority right now. The Fed is not fighting inflation. The Fed is basically trying to get job growth as in the forefront. So we are going to deal here with high job growth, and that will entail high demand for commodities in general and crude oil and natural gas in particular.
Now, are consumers making enough to take this in stride if we do have higher inflation and higher gasoline and oil prices, or are those oil prices, are they going to impact consumer spending this summer, even enough maybe to throw this country into a double-dip recession?
Well, in a way it did, but again, remember, bubbles could last years. We've seen what happened in the last bubble. Oil prices were basically on a tear between 2005 and 2008, and it came to a screeching halt after they ran up to $148, and everybody was convinced at the time that oil prices will go to $200, all of a sudden we saw oil prices in the $30 range. So, and before you know it, everybody thought that oil prices will remain under $50, and all of a sudden we saw oil prices coming back again to $85. So the correction from $150 oil to $30 oil was not really dictated by supply and demand fundamentals, but also the recovery between $30 oil and $85 oil was also not dictated by improvement in supply and demand fundamentals.
Last question, we talked a little bit about natural gas prices moving up as well, along with oil prices. Are we going to see a return to double-digit natural gas prices?
Very highly unlikely. I think that the whole idea of double-digit gas prices to start with was basically some, it's unrealistic, and it came because of almost a perfect storm with, the hurricane, excessive speculation, the run-up in oil prices. So all these things, gave us the $15 natural gas. It is very unlikely to see natural gas prices above $9 for the foreseeable future. One can see that any jump in gas prices will be corrected very quickly, because supply and demand fundamentals will keep, in my view, natural gas prices probably between $5 and $7, $6 and $8. We're not likely to see double-digit natural gas prices in the foreseeable future.
All right, Fadel Gheit with Oppenheimer, thank you very much for joining us.
Thank you.
You bet. We've been talking with Fadel Gheit, Senior Energy Analyst and Managing Director at Oppenheimer. I'm Dan Goldstein, and you've been watching Clean Skies News.